What's known as a K-shaped economy, what we're in right now, could actually be creating more risk in the stock market. Are you prepared for this risk? How can you prepare before this risk poses a big threat? Got that more coming up. There's a lot of financial noise out there, and there are times when you just need to set all that aside and say, okay, well, what directly influences the stock market? And that is company earnings, corporate profits, earnings, right? And it's not even past earnings, although that is important, but it's projected in future earnings. So despite all of the noise, the stock market or the value of a company as it's traded on the stock exchange is influenced by their profits, right? That is really what drives it. Well, if it was only that simple, because what drives profits? Well, there's all sorts of factors that drive profits, okay? And certainly a lot of economic factors, and one of which, maybe one of the most important, is the consumer. Consumer spending, the consumer's overall financial condition. Are they in a healthy position? Will they continue to spend? And a lot of other factors. And so if only it was as simple as just saying, well, yeah, company profits drive the stock market, so let's just focus on profits. No. What drives profits? And so much of it, essentially 2/3 is what the data shows, of the economy is really driven by consumer finances and consumer spending. Therefore, keeping a watchful eye on, well, how's the consumer doing is a key pattern or a key part of understanding, well, where could the market be going? What risks lie ahead? Well, right now, you may have heard this. We've talked about it a little bit here on the channel. Economists are saying we are in a K-shaped economy where there's the haves and the have-nots, all right? And that sort of forms this K. And a lot of economists point to with those with high income, they're the haves, they're feeling great in this economy, and those with lower income, they're struggling and living more paycheck to paycheck. And I would absolutely say that that's true. However, it's more than just income. It's actually has a lot to do with assets. Those who have owned assets have seen their net worth and their financial picture really materialize over the past several years after COVID and all the money printing. And those that didn't own assets really have probably felt like, or maybe on paper, have been more so left behind. And documented this, actually, I remember during COVID, talking about the Cantillon effect. Right here on this channel, we were just really starting our big presence on YouTube back at that time when everything was changing. We just said, well, let's start talking about what's going on and help people see it from a financial planning perspective. And so the Cantillon effect is essentially as monetary policy, it goes out and is printing money. Well, that money doesn't flow evenly across the economy. Even if you say, I want this money that we just printed, central government, central bank, I want it to go here. Oftentimes, it's more so like a big blob of honey that is kind of splattered on an ice cube tray. Eventually, over enough time, it's sort of going to spread out, but it's really going to be lumpy and it's going to cause a distortion. And one of the first causes is it causes asset values to go up. So the stock market, yeah, that's an asset. It's the ownership of companies or the value of companies, housing values, and even vehicle values, those sorts of things. Those are assets. And yeah, if you've owned assets, if you owned a house in 2019, if you owned stocks in 2019, if you owned vehicles in 2019, and you've held them, or even if you've exchanged them, but you've essentially continued to be an owner, your net worth is likely much higher than it has been in the past, maybe the highest it's ever been, because you've owned assets. If you haven't owned assets, then it's been much harder. Maybe you haven't felt any big change in your net worth. And guys, that right there, some economists are saying is posing a new or different threat to the current stock market levels. So that's a long way around, but let's go back to what typically drives the economy, consumer spending, okay? And what drives stocks is the profits, right? So we are a consumer-driven economy. Therefore, people go out and spend money, and that drives, company profits and that sort of thing. Well, the consumption patterns are different and they're changing, okay? So those that are on sort of that lower end of that K, they are spending what they have, right? There's not as much income and therefore they're spending it on needs. There's not a lot of discretionary income and they're struggling. And really, they are. Those that are more so on that upward trajectory of that K, there's more and more research showing that, well, they are spending out of their savings. They are spending out of their savings. Their assets have grown in value. So their investment portfolios, their housing values, their asset values have grown. And that group, which traditionally has been net savers, they're the ones that have driven a lot of the savings rate of the overall economy. Their net savings, new research is showing, is closer to zero. There's not as much of it, meaning they're spending all of their money as well, and even spending from some of the assets that have gone up in value and ballooned in value. Therefore, this research is showing that if we see the stock market start to falter, which we've kind of felt a little bit of at the beginning of this year, but if the stock market starts to decline, asset values temporarily, if they start to decline, which they inevitably will at some point, that could actually drive consumer spending down from those folks in this K-shaped economy that had been feeling fairly confident and fairly optimistic. They could start feeling negative, start spending lower, and all of a sudden that could spiral things into a very challenging recession and challenging economic environment. Therefore, it's not too great of a leap to say that, yeah, this precarious situation that we're in with this have and have-nots in the economy, the haves could very quickly shift to having a feeling of have-nots, or if the stock market declines, go from having to not having, and that could create a greater risk for the overall stock market. So what do? This poses a unique problem set for you and me, those of us long-term investors, right? You've got to own assets. You have to, because the money printing hasn't stopped. And yes, the Fed is decreasing their balance sheet, but the money printing has to continue. We're running a deficit and all that. So the money print, you've got to own assets, okay? But owning those assets right now feels like it's coming at an even greater risk. So what do? You've got to, yes, have a diversified overall portfolio, but as I've said before, you've got to have other diversifiers beyond just mixing, having a mix of U.S. and international, large, mid, small stocks and bonds. You've got to have more diversifiers than just that. And I've shared a few before. These true diversifiers are ones that, as the stock market goes down, they will behave differently, okay? So oftentimes, the idea of diversification, don't have all your eggs in one basket, it's thought of, and research has shown that, those baskets won't all move in the same direction at the same time. Here's the problem. History's shown that we go risk on and we go risk off. And when we go risk off, which we're starting to feel a little bit right now in the stock market, all of those different baskets tend to go down at the exact same time. All of them tend to go down at the exact same time. And it's not perfect, but there are times when that can occur. When you need diversification to help, it doesn't show up. And therefore, these true diversifiers that are likely pieces you need to add to your portfolio are ones that contractually or will show up. They're structured a little bit differently, so they will show up when the stock market starts getting jittery. These are things like hedging your portfolio. Done a lot of content on that, and you can do this in a few different ways by actually buying option contracts yourself. You can go out and buy exchange traded funds, ETFs that focus on this sort of thing. There's a lot of different ways that you can hedge. Another is you can own equity income type investments that are designed to own stocks and have that appreciation, but also have some income as well that will be paying out whether the stock market is rising higher or declining. And so those are just two of the ideas, two of the ways that you can bolster your portfolio and still own stocks and still own assets to long-term appreciate, as we've seen since over the past 5-6 years. However, manage risk during the times when we see more volatile time periods in the stock market due to these elevated levels of risk. So work with your certified financial planner on that. Take a look at the structure of your overall portfolio. Make sure it fits within your financial plan. Make sure that you've got the right diversifiers, the right complementary pieces to reduce correlation, sorry for that jargony term, but to manage risk even better at a time when you need to own assets, but risks remain elevated. So work with your CFP on that. If you don't have a CFP on your team, contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.